Good evening, everyone, and welcome to tonight's webinar. Tonight's timely and yet somehow timeless topic is tax planning for retirement. I'm Nancy Fellinger, and I'm one of the financial planners here at Sensible Money. Dana Anspaugh is presenting tonight. She is the founder and CEO of Sensible Money and is among the nation's premier retirement decumulation thought leaders. Dana is also the author of Control Your Retirement Destiny, which has for several years now been recognized as one of the very best guides out there on the subject. If you like to read, if you like to rather listen than read, Control Your Retirement Destiny is going to be available as a podcast through iTunes and several other podcast services as well. I believe, Dana, you're up to chapter 10. Dana's in Scottsdale, Arizona, and I'm in Pawleys Island, South Carolina. We have Sensible Money team members in other states as well, and using the same technology that we're using tonight, we work with clients all across the country. If you've watched any of her webinars, you'll know that Dana believes no question should go unanswered. And so we'll have plenty of time at the end for you to ask questions. And you can certainly add them to the chat box as we go. Tonight's webinar will be recorded, and you'll be seeing an email in your inbox with a link to the webinar within the next several days. And of course, we'll also be including a copy of this presentation. So again, welcome to tonight's webinar. We hope that you will find it not only enlightening, informative, and timely, but also enjoyable as well. So let's turn this over to Dana now and get started.
Thank you, Nancy. I really appreciate everyone taking the time to join us tonight. And I want to let you know I have been fighting off a cold, so if my voice sounds a little scratchy, for those of you who have listened before, it is scratchy. But I didn't want to cancel or reschedule, so here we go. We are going to be talking tonight about how to add tax alpha, meaning how can you add the equivalent of rate of return to your retirement plan through smart tax planning. It's really not about, your gross amount of assets, your gross income. It's all about what's left after taxes. That's what you can take to the bank and spend. That's what you have to live on in retirement. So what we're going to do is work our way through 7 different layers of tax efficiency. And I'm going to explain each one of them, how they work. We're actually going to be looking at some screenshots of the brand new 2018 tax return, which does look quite a bit different than it has in the past. But the concepts haven't changed, and the way you apply them hasn't changed. Just some of the underlying details have changed. So briefly, I'm going to walk through each of these 7 things. We're going to talk about layer number 1, owning a mutual fund that minimizes distributions. So this first one is going to apply to those of you who have savings and investments that are not tucked inside of IRA or Roth IRA or 401k accounts. You have a brokerage account and you've been saving and adding money and investing, or you inherited assets after tax. We're also going to be talking about asset location, number 2. As you accumulate savings in different account types, how do you make sure that the investments are in the right types of accounts to make it as tax efficient as possible? We're going to be talking about harvesting gains and losses. And so number 3 is also going to apply to those of you who have investments that are not tucked inside retirement accounts. We're going to be talking about funding retirement accounts. So as you're still saving for retirement, what hierarchy should you use as to where you put your money? And then when you shift into retirement, how do you withdraw tax efficiently? What are the factors to consider? And then I'm going to talk about the difference between applying all of those factors using a very general set of assumptions, an assumed tax rate, versus doing it based on an actual tax projection, what your personal tax rate will look like. And those 2 things deliver very different answers. So, as Nancy said, if you have questions along the way, feel free to type them into the chat box. We may not stop as we're going, but if Nancy sees something that's particularly relevant, or if someone didn't understand something I said on a particular slide, she will certainly interrupt me and ask for clarification. But any other of the questions that are broader or general, if something pops up in your mind, feel free to type it in. And when we get to the end, we're going to leave time for Q&A. So number 1, making sure that you own mutual funds that are tax efficient. So this is a quote from Morningstar, and this was a study they had done in 2014. It's been replicated many times over the years. And it says that some investors are surprised to find that they have to pay taxes on capital gains and dividend distributions from their mutual funds and ETFs. An ETF stands for an exchange traded fund. even if they didn't sell their funds during the year. So when you own investments that are not inside of a retirement account, you get a 1099 every year, and it reports capital gains and losses and interest and dividends, and you have to pay taxes on those. And the tax efficiency of the funds you own can vary widely. And the Morningstar study said that over the past 10 years, the average annual tax cost for a mutual fund was 1.3%, meaning after taxes, you earned about 1.3% a year less because you had to pay taxes. Well, we all have to pay taxes. We know that. And so the question is, what can we do to reduce that annual tax cost? But before we get into that, I want to explain, how does this happen? How do you end up paying, for example, capital gains? How could you have a capital gain from a mutual fund when you didn't actually sell any shares? Well, here's a simple example. Let's assume we have a mutual fund that has, among others, these 5 stocks. And I'm going to throw out a pop quiz really quick. Anyone have any idea what these 5 companies have in common? Anyone who wants to play along and type an answer into the chat box, what do these 5 companies have in common? Anybody want to take a guess? No? No one's going to play along? Oh, I see a few guesses coming in. Thank you. Ooh, I see one answer that could be correct, but I actually don't know. So I love it. These stocks are all very widely owned. That is true. I see a few answers that says they pay dividends. I'm not positive on that. They may all pay dividends. I'm not sure about Nike. That they are all in the Dow. That's the answer that could be true, but I don't know. What I do know is that they are all in the S&P 500. So all 5 of these stocks are in the S&P. And so thanks for playing along. So let's assume this is an S&P 500 index fund. And there's an expense ratio that comes out. So the value of your mutual fund depends collectively on the value of all of the underlying stocks that it owns. And each year, the mutual fund managers, they charge something to manage this fund. And so there's an expense ratio that comes out, and then you're left with your price per share. Well, believe it or not, the S&P 500 is far from static. So there have actually been 4 changes already to the number of stocks that are in the not the number of stocks, but to the actual stocks in the S&P 500 already in 2019. 3 of those changes were due to acquisitions, and 1 was due to a bankruptcy. And so these underlying stocks change, and sometimes they're replaced. So out of curiosity, I looked up at, when did Apple become part of the S&P? It was 1982, and then it actually also became part of the Dow in 2015. And then, for example, in 2018, Twitter got added on to the S&P 500, and it replaced Monsanto. And lest you think that technology stocks are always replacing more traditional companies, interestingly enough, in 2017, Hilton was added on and it replaced Yahoo. So there was an example of a more traditional industry, the hotel industry, replacing a technology company. So there are changes to the S&P, and each time a mutual fund, the S&P changes, the mutual fund has to change. And so it has to sell, for example, all of Monsanto and buy Twitter. And so that transaction creates a capital gain within the mutual fund, and then they distribute the proportional share of those gains to you as the shareholder. And so some funds have a lot more activity. An index fund has a lot less trading than, for example, an actively managed fund that's trying to time the market or use a particular strategy. Certain funds like international funds or sometimes small cap funds or commodities funds are a lot less tax efficient than large cap index funds. And so there's a wide variation in how tax efficient your mutual fund is. Regardless, though, if you own a mutual fund, there are going to be years where it pays out capital gains even though you didn't sell anything. And one part of the tax forms that has not changed is Schedule D. And so this is not a current year schedule, but I did compare it to the current year and it looks virtually identical. So what you're seeing here is a screenshot of Part 2 on a Schedule D tax form. And here you see that this person had a transaction where they sold $75,000 of an investment but its cost basis was $77,000, and so there was a loss over here. But down here, line 13 is where capital gains distributions come through. And here you see $4,000, and that was not from something they bought or sold. That was from what I just described, from the activity within the fund, and then it flows through, and there's a special place on your tax return where that gets reported. Now, that gains and losses net out, and so here the result was that they had a net gain of $1,782. That actually wasn't their final result. We'll look at that later, but that was the result at the bottom of this page. So that's where these fund level gain distributions get reported. And a lot of times mutual funds distribute gains in the fall. So occasionally people will, let's say you inherited money and you put it all to work right in September, and then instantly in October or November, December, you get a big capital gains distribution. We've seen people be surprised by that. And so it's just the way mutual funds work. It's one of those things that comes along with owning funds. But you can definitely look to own funds that are more tax efficient, and we'll talk about that in a second. So when we look at this hierarchy of funds that from those that are least tax efficient to those that are most tax efficient, in general, it looks like this. At the very top, you have things called tax managed funds. So there are mutual funds that try to balance out their gains and losses within the fund to reduce the amount of distributions that you have to report on your tax return. Now, again, if you own these funds inside of an IRA, a Roth IRA, or a 401k, none of this matters. You don't report any of the transactions inside retirement accounts until you actually withdraw and use the funds. But if you start to accumulate assets outside of retirement accounts, that's where this layer of tax efficiency applies. So then you have index funds, large cap, small cap, international, getting less tax efficient as we go. And then it often makes sense to own your real estate, commodities, government, corporate bond, high yield bond funds inside of your tax deferred accounts. These are less tax efficient investments. So that's layer number one, is how do you own investments outside of retirement accounts to make them as tax efficient as possible. And with this slide, we start to get into layer two, which is asset location and how do I choose which account types to put my investments into. So as we move into tax efficiency factor number two, let's start by looking at asset allocation. So allocation is how much in general is in stocks, bonds, cash. And then, of course, within stocks, how much is in large cap versus small cap, international, emerging markets, value versus growth. Within bonds, it could be how much is in short-term bonds, intermediate, long-term, government, corporate. But here, we're just going to think of this in terms of big categories. So I have bonds in gray, and I have large cap stocks in the darker orange, and emerging markets in the lighter peach color. And regardless of what the components are, a lot of households will balance each account the same. So here we have a household that has $1 million, and they have it across an IRA account and a non-IRA savings, like a brokerage account. And each account is balanced about the same. And that's pretty common for us to see that. Excuse me. And so is that the best way to do it? A lot of times people do that because they don't know what else to do, or they follow an allocation model and it's easy to just have each account balance on its own, a 401k account, for example, or spouses will balance each of theirs independently. But from a tax standpoint, there may be a more tax efficient way to do it. So if we were to apply asset location to the same household, here's the same $1 million, and as a household, they have the same dollar amount in each asset type. But in the IRA, we've put the majority of the bonds because bonds are going to generate interest income that's taxable anyway. So why wouldn't I tuck that inside my IRA where I'm not going to pay those taxes until one day when I draw it out? And we put the large cap in the IRAs. And then over here in the non-IRA, we had emerging markets and additional large cap and then a small amount of bonds left over. And so this is not a perfect example. It's just a sample of how you might locate different investment types within accounts to make the overall outcome a little more tax efficient. When you look at some general guidelines that you can apply, your investments that have the highest potential for return, typically that's going to be small cap and emerging markets. You would tuck those into the Roth accounts if you have Roth IRAs or a Roth 401k. And that's because everything inside a Roth grows tax-free. So obviously you would want the greatest gains to be free from taxes. If you have investments that produce long-term capital gains and dividends, those are taxed at a preferential tax rate. We'll look at that in a second. So usually you would own those inside of a non-retirement account, a brokerage account, where you do get a 1099 each year because that type of investment income is taxed at a lower rate than other types. And then if you have excess fixed income, which is bonds or high turnover investments like commodities and real estate, actively managed funds, you would own those inside your IRAs or 401ks because you're not going to pay taxes on any of that activity until you actually take withdrawals. And then the last consideration is that higher tax rate households are likely going to want to use municipal bonds for any fixed income that they're going to own inside non-retirement accounts. And typically there's no reason to own municipal bonds inside of a retirement account. So a municipal bond generally is free from federal income tax. And if it's a bond issued by the state you live in, then often it's free from state taxes also. And so that tax-free nature of the cash flow, if you hold it inside of a retirement account, it doesn't apply. But it does apply if you hold it outside of a retirement account. The one caveat, don't let the tax, wait, how does it go? Don't let the tax tail wag the dog. Don't let the, I think that's how it goes. So the point is, when you get near retirement, you're going to have a set of cash flows. Your money has a job to do for you. And so you don't want to make everything so tax efficient without applying the first layer of, wait, when am I actually going to need this money? And let me show you what I'm talking about with that. Here is a household where they have about 600,000, 700,000 between his and her IRAs. And then we have this non-IRA account over here. And this is the account they will actually be drawing out of first. Now you may say, how could they be drawing out more? You know, if you mentally add up these numbers and what they have, well, there are contributions going into this account behind the scenes, so they are saving up until retirement. So this balance grows, but this was its starting place in 2016. And so, as they're accumulating money in this account, before we apply just pure tax efficiency to their asset location allocation decisions, we want to think about, wait, what accounts are they going to use? So in this case, they're going to be using this non-retirement account first, which means we're probably going to have municipal bonds, fixed income that's maturing, so that these cash flows are secure. So that, you know, if they're a few years into retirement and they need to take 128,000 out, they don't have to worry if the market's down 30%. But if we look over here, when this plan was built, there were 11 years before Sam's IRA would need to be touched, and even longer before Sarah's IRA. And so these accounts, in their case, could be 100% growth, 100% stock index funds, because the time frame that's being applied. So when we say don't let the tax tail wag the dog, that's what we're talking about in terms of, you know, if you're farther away from retirement, you can locate assets in a way purely to maximize tax efficiency along the way. But as you get closer to retirement, you're going to shift that to actually aligning the investments to the point in time where you will need to use them and matching them up with which account they will need to come out of. And when we get to point number 5 on withdrawing tax efficiently, we'll be talking a little bit more about that. Let's talk about the factor number 3, gain loss harvesting. And again, this applies to, like factor number 1, to investments that you own inside non-retirement accounts. So there's 3 specific things that we're going to talk about. 1, realizing capital gains when they will be taxed at zero. And yes, there is a 0% tax rate that I will show you. 2, realizing losses when that loss can be deducted against ordinary income, and realizing losses that fall into a higher cap gains rate. So let's take a look at what I mean. Here are the capital gains tax rates. So in 2019, if you're single and your taxable income falls in this 0 to 39,000 range, or for marrieds in this 0 to 78,000 range, there is actually a tax rate of 0. And it applies to QD and LT. QD is qualified dividends and LT is long-term capital gains. And so if you were to sell a stock or a mutual fund or a real estate that wasn't your primary residence, this rate would apply if your taxable income was low enough. So you actually pay nothing on capital gains. And there's many opportunities where somebody might be between jobs. They might, have taken an early retirement package, be unemployed for a while, or perhaps they're retiring and one spouse is continuing to work, or they're retiring but they're delaying the start of Social Security. There are many opportunities that we see usually in the ages between 60 and 70, where this tax rate can be manufactured on purpose, where things can be structured so that someone intentionally falls in this tax rate for a few years that allows us to sell certain types of investments and pay very little, sometimes nothing, on the gains. As your income gets higher, you see the next range, then capital gains begin to be taxed at 15%. And if you're in the very highest income levels, then your capital gains will be taxed at 20%. So these are where we want to realize gains when they will be taxed at 0. So if you're in a tax year where if you realize a capital gain, you pay no taxes, that's a great time to realize that gain, even if you just move from one investment to another one that's very similar, because you've now will never pay tax on that gain. It was truly tax-free gains that you were able to acquire by making that move. And I'll show you an example of that in a minute. The next thing is realizing a tax loss, but not an investment loss. And this actually applies to what I was just talking about at realizing gains at 0 also. So what you're looking at is a screenshot off of Yahoo Finance, and it's comparing a Vanguard S&P 500 index fund with a Schwab S&P 500 index fund. And you can see that they are going to move in virtual identical fashion. They both own exactly the same things. There's some very minor differences. Believe it or not, the Vanguard fund has an expense ratio of 0.04 and Schwab at 0.02. Vanguard has a $3,000 minimum. Schwab has a $1 minimum. It's pretty amazing. But here's what we mean. So let's say we look at, this was December of 2019 that you're looking at here. And obviously the market went down and people were alarmed. And in this case, it was very short term, right? This is where we were at when I screenshotted this, I think yesterday. And so it was a decline and then a pretty rapid recovery. But at the end of the year, we were busy with our clients doing something called tax loss harvesting. So let's say we were going to transition from this Vanguard fund to the Schwab fund. Then this loss was captured for tax return purposes, but they didn't really realize an investment loss if on the same day they just moved from one fund to the other, because as the market recovered, they were still in this new fund and able to participate in the recovery. And so that could apply to realizing capital gains at a 0% tax rate. You could exchange from one fund to another very similar fund. And it definitely applies for losses. And I'm going to show you how those losses actually can get used on your tax return. But what you don't want to do is realize that loss and then just sit in cash. And so then you realize a permanent loss. But by exchanging from one fund to the other and being able to participate in this recovery, all you were doing is making that move to capture the loss for tax reasons. And this would also apply if you want to offset gains that fall into a higher cap gains rate. So let's say earlier in the year, your portfolio had been rebalanced and you had capital gains, and you know that your income is going to fall into a tier where those cap gains will be taxed at 15%. Well, maybe near the end of the year, last year, you could have realized some losses that would bring that back down. So there's definitely some strategies that can be applied as you start to accumulate assets that are not tucked inside of retirement accounts. So when we talk about this loss and how it can get used on your tax return, here's what it looks like. Here, again, we have this cost basis, and you see that in this part 1, short-term capital gains and losses. And then we have these proceeds. And so this person had a short-term loss. But then we go to the next page of their Schedule D. And again, we see basis and proceeds, and they had also a long-term loss. And this is the same screenshot we were looking at early, but they had these mutual fund gain distributions that came through, and all of that netted out. And so in long term, they had a 1782 long-term gain. But gains and losses get to offset, and the end result was there was $7,700 of loss for the year. Well, what happens? Well, you're allowed to use 3,000 of it against ordinary income. So this is what it looked like on the tax return a few years ago. It looks completely different this year, but you would see it flow through to line 13. And so you would see this loss here in the midst of all of these other sources of income. And so it actually reduced your taxable income, and the rates that are applied to your ordinary income are much higher than capital gains rates. So in this case, this $3,000, if you look at this particular person, they had $164,000 of income, and then they get to use the standard deduction, which in 2019 is $24,400. And so they would have basically $140,000 of taxable income, which would put their tax rate at 22%. And so this $3,000 helped save them $660 on their tax return. And again, it was just an exchange from one fund to the other. And I think I saw a question around the wash sale rule. So the wash sale rule can apply if you're buying and selling the same security. But when it comes to funds like Schwab and Vanguard, let's say you decided, well, I own Vanguard and there's a reason I want to go to Schwab because it's 2 basis points less, or I prefer, Schwab's branding, or, if you're going the other way. I mean, there's numerous other reasons, and it's not the same security. And so it has a different ticker symbol, and it has a different fund manager. And so even though we know both funds own virtually the same thing, it's not the identical security. Now, if you were buying and selling shares of Pfizer or Apple, we looked at those individual stocks, and you bought and sold those within a 30-day time frame, then the wash sale rules applies. They are the identical security. And so that the wash sale is something that the software we use tracks all of that and accounts for all of that. So you do have to watch out for it, but it has to do when you're buying and selling the exact same security. So a few other things that you notice on this tax return. One, tax exempt interest here. And so I'll just point out, if you're in a higher tax rate, in this case, after taxes, this person would have to have earned $5,900 in ordinary interest income to have it be the same as this $4,550 of tax-free municipal bond income. And so that's a difference in yield of about 0.67%. And so there's an analysis that you can do when trying to decide whether to own regular bonds that have taxable interest or municipal bonds that generate tax-free interest. And the higher your tax rate, usually the more beneficial the tax-free becomes. And then you also see this qualified dividends. So most mutual funds have dividends, and the total amount of the dividends went into box 9A. This is, again, the old tax form. But the qualified amount, all of this is taxed at that preferential tax rate, where we saw that a 0% rate can apply and the 15% rate can apply, versus their total income will pretty much be taxed at 22%. And so there's a lot that you can learn from studying a tax return and then figuring out how you can restructure the investment so that it can reduce what you actually have to pay taxes on. we looked at this already. I have a duplicate slide in here, but here's where you see that $3,000 that comes in and actually gets deducted against ordinary income. And that brings us to number 4. And so how do we fund accounts in a tax efficient way? And what you're seeing up here at the top are annuities and life insurance products. And at the bottom, you're seeing things that are not deductible: Roth IRA contributions, non-deductible IRA contributions, non-deductible contributions that you convert to Roth conversions. And so let me start at the bottom, actually. So with a Roth account, you put money in and you do not get a tax deduction on it. But from that point on, the funds grow tax-free. And assuming you follow the rules when you withdraw it, you withdraw it tax-free, and there are numerous other benefits. Those withdrawals, because they're tax-free, they don't bump up your other income, which can make more of your Social Security taxable. They don't bump up your income that can put you into a tier where your Medicare Part B and D premiums go up, and we will be looking at both these items. So there's all kinds of advantages that tax-free income has later in retirement. And so the traditional way of looking at things are that, a lot of people want to maximize their tax savings today. So they put all their money into, their traditional 401k, traditional IRA. But we have the advantage of seeing what it looks like once you retire. And one of the worst situations we see is someone gets to retirement and they have $1.5 million in a 401k or IRA. Doesn't sound so bad, does it? But literally that's all they have. It's in an IRA or 401k, and they have Social Security. And naturally, they think they're wealthy or well off. $1.5 million is a lot of money. But because of the tax piece, every dollar they pull out will be taxed, and it just doesn't go that far. If they got to retirement with the same $1.5 million, but half of it was in a 401k and half of it wasn't, their situation would look very different. And so we were having this conversation here in the office the other day about the benefit of Roths. And I thought, to me, one of the benefits is that it actually increases your savings rate. A lot of the calculators that you use that can plug in Roth versus traditional, one, they do not accurately take into account how it looks upon distribution. They use an assumed tax rate. We'll talk about why I don't like that. And two, they assume that when you put your money in your traditional 401k or IRA, you saved money on taxes and that you saved that savings. Who does that? We don't do that. We put money in our 401k and we didn't pay as much taxes. We don't take that exact amount and then go deposit it into a brokerage account. And so by using the Roth, it actually increases our savings rate. I think they're phenomenal. I think there's many reasons even for higher tax rate households to use the Roth. And a lot of 401k plans now allow you to put money into a Roth. If you do that, your employer contributions or match will still go into the tax deductible or tax deferred bucket, but your contributions will go into the Roth. Then in this middle tier, we have the deductible, your health savings account contributions, your deductible IRAs. You can make a contribution for a spouse, even if they don't work. So you can make an IRA contribution for them. Your 401k, 403bs, 457 or deferred comp plans. And if you're self-employed, SEPs or Simples, or there's things called individual 401k plans. And so all of those are where you put in deductible contributions. I have HSAs highlighted because they're one of the few vehicles where you get a deduction when you put the money in. It grows tax-free, and assuming you use it for qualified medical expenses, it is tax-free when it comes out. There's nothing else like it. It's amazing. I think everybody who is eligible should use HSA accounts. They're really one of the few ways you can truly grow money tax-free, and it's just there's nothing else like it. They're amazing. So then at the very top, you have annuities and life insurance products. And occasionally I get questions on people who have read books on, bank on yourself, using whole life to fund your future. And for very high income households, these products can work if they've already maxed everything else out. They're not as magic as sometimes I see them appear to be by the people who are selling them. the way they depict it. So when you actually run the analysis, if you're super high income household, using these products can work if you have the cash flow to fund them for 20 years. And particularly if you are a household that needs creditor protection. There's a certain type of creditor protection that's offered within these products. And so if you're a business owner or in the medical profession, a high-risk profession where you're worried about being sued, there could be an additional advantage for using some of these savings vehicles. When you look at how much you can put in, I made a copy of this available as a download. So if you see a little dialog box where, from the GoToMeeting panel, you should see 2 downloads, and this is one of them. There's a lot more information on it than what I screenshotted here. But here you see the 2019 limits. This is the maximum amount you can put in for each plan type. And there's a funding deadline. And so for many of you, you're still eligible to put a contribution in for 2018. So there's these deadlines you see over here. And a lot of times we see people who don't think of some creative ways to fund retirement accounts. So let's say, for example, you have, money in a brokerage account, you inherited money, or you've been putting money into a mutual fund. So, you want to fund your IRA, and you think, well, I have to come up with that savings. Well, a lot of times we find that instead we're just shifting money from one type of account into the IRA account for our clients. And so wherever you might have money, if you can use it to get it into some of these tax advantage accounts, it makes sense, particularly with the Roth. So one of the neat things about the Roth IRA is your contributions. Let's say you're eligible to put $6,000 in. You can always take that contribution amount, that $6,000, back out without tax or penalty. You don't have to wait to 59.5 to access that. And so that makes it, I don't want to say double as an emergency fund, but it's a little more liquid. At least some of that money is available to you. So as people accumulate savings outside of retirement accounts, I think it can make sense to use the Roth. Every dollar that Roth earns is going to be tax-free. Why not put it into a vehicle where it will be tax-free? Now, are you eligible to fund the Roth? Well, here are the income limitations over here on the right-hand side for the Roth. So if you're a single and your adjusted gross income is over $122,000, your ability to contribute to the Roth IRA phases out. Once you're over $137,000, you can't put any money in. For a joint, 2019, it's $193 is where that phase out begins. And then over here, you see the limits for 2018, which still apply as you are not at April 15th yet. So you can still make a contribution for last year if you're eligible. You also see these income limits over here on the left. And so if you have a plan through work, here it talks about if you're a participant in a company-sponsored excuse me, or company-sponsored retirement plan. What these income limits say is the IRS says, well, you should be using your company-sponsored plan first, right? And so if you're a single and you make more than $64,000, we're going to phase out your ability to contribute to an IRA and deduct it. And if you're a joint and make more than $103,000, again, we're going to phase out your ability to contribute to an IRA and deduct it. What if you're married and only one of you has a company plan? Well, that's where this bottom income limitation applies. You can still make a non-deductible IRA contribution, and there can be reasons to do that. Perhaps you can accumulate a few years worth of contributions and then eventually convert those non-deductible IRAs to a Roth. It's something called a backdoor Roth funding strategy. And there's some particular rules you have to follow. And so if you Google backdoor Roth strategy, there's an article by Michael Kitces that does a great job of explaining when that does and doesn't work. So those are some of the things to think about when you're on the funding side, when you're saving for retirement. Then you have the withdrawal side. So now you're looking at withdrawing tax efficiently. And this is a piece from Vanguard that goes through and what they did was try to identify do advisors add value? And in what areas do they add value? And how do we quantify that? And so these were the two areas, asset location, that we looked at that they felt like could add the equivalent of about 75 bips. What is a bip? It's called a basis point. So that would be 3/4 of 1%. 1% is 100 basis points, and so that's 10 basis points, for example, is 1/10 of 1%. And so here's what we're talking about here: the spending strategy or withdrawal order. How do you take money out in a way that is as tax efficient as possible? And their view is that you could add up to a 110 or 1.1% equivalent return by doing that. Well, there's several factors that come into play. One is the taxation of Social Security. And so when we look at that, we've got a weird formula. There's no other way to describe it. And so a lot of people look at these threshold amounts and they go, well, if I'm single and I make over $34,000, my Social Security is all going to be taxed at 85%. Or if I'm married and I have over 44, it doesn't quite work that way. This formula that you see down here actually means that in any given year, anywhere between 0 and 85% of your benefits can be taxed. The good news, I like to frame it positively, 15% of your benefits are tax-free, no matter what. But couples can make up to, I believe, almost $90,000 a year and still perhaps not have of the full 85% of their Social Security tax. It has to do with your other sources of income and the ratio of Social Security to your other income. So I'm going to walk through an example that is actually in my Social Security Sense book. And so I wrote this book in 2015, right after the Social Security rules changed, and it only talks about Social Security. It's much shorter than my Control Your Retirement Destiny book. But this example took a look at a couple, age 67, and they were retired. And here what you're looking at is their adjusted gross income for the year was going to be $58,000. You can see their taxable income, which was after any standard deductions, and at that point we had personal exemptions, and they were going to pay $4,388 in taxes, and that left them $55,612 to spend. Now, this graph comes from an online calculator. I've got a link to it at the end of this presentation, and everybody is going to get a copy of this presentation emailed out, so you will have access to all the links. And so it shows you the taxable portion of their benefit and the non-taxable portion of their benefit. And if you want to see the details, you're going to get a copy of these slides also. But this online calculator breaks all of this down and shows you how it's applying the formula. And so 85% of their Social Security is going to be taxed. Well, let's fast forward to what happens a few years later. Now they're both age 70. And one of them was taking a spousal Social Security benefit and delaying their own Social Security. So they're getting more Social Security now because they're age 70 plus. And so now their adjusted gross income is $24,000. It's much lower. Their taxes, only $90. What do they actually have to spend? $59,000. So more. And why? Well, they're getting a lot more Social Security and almost none of it's taxable. So you can go through the details, and here their total Social Security they're receiving is $40,000 a year. If we go back a few slides, the total Social Security they were receiving at the age of 67 was $10,000 because only one spouse was collecting a spousal benefit. So they're getting a lot more Social Security, but the way the formula turns out is a lot less of it is taxed, only 10% of it. And so for some people, there's a way to coordinate how money comes out of which accounts to see if it's possible to keep the amount of Social Security that's taxable at a lower end. Now, if you didn't follow all that, don't worry. It's very complicated. And so again, we use software and calculators that factor it all in, but it's knowing what to look for. I was talking to a colleague the other day and about some of this, and they're like, there's just so much information. I said, yeah, and there's no way to remember it all. What you do have to remember is that there's something there that I have to go look into. There's something there that will apply. And so there's a lot of online tools that we have to use to keep all of this together and actually apply it to a client situation. So when it comes to withdrawing tax efficiently, you have the Social Security formula that we just looked at, and then you also have required minimum distributions. And so here, you're looking at the way the formula works. This is for every $100,000 that you have. At age 70, you have this divisor, and so you would take your year-end balance on December 31st, divided by this divisor, and this would be the dollar amount you would have to take out for every $100,000 that you had. And here you see what that is in terms of percentages. The divisor goes up as you get older. So, for example, by the time you're age 84, you have to withdraw 6.45% of your remaining account balance. Almost double what you had to withdraw at 70. So every year you have to withdraw a larger portion of your remaining IRA, 401k, any of those tax-deferred accounts. And so a lot of times what happens is all of a sudden you have this extra income on your tax return, and it also means more of your Social Security is taxed, and it can be like this tax bomb waiting for you that catches people off guard. And this is one of the reasons that for some people, it makes sense to take money out of the IRAs earlier. Perhaps between the age of 60 and 70, they can take money out of the IRA or convert some of their IRA money to a Roth IRA. When you convert, money comes out of the IRA. You don't have to convert all or nothing. You can do a piece. You pay taxes on the amount that comes out of the IRA. You deposit it in the Roth, and from that point on, it grows tax-free. There is no income limitation on Roth conversions. So we looked earlier at some of those income limitations on whether you can contribute to a Roth from earned income, but that rule does not apply to converting IRAs to a Roth. When we put all of this together and try to create a tax-efficient plan, here's a sample plan where what you're looking at is each column is a calendar year. And you see this horizontal line, and everything below the line is money going out. So in orange are their living expenses at $91,354 a year. And in this case, this person wasn't going to withdraw from their IRAs until they turned 70. And over here, you see this was a couple, age 66 and 64 in 2017. And out here, you see this yellow piece of that starts to show up. And the yellow is taxes. And so you'll see that yellow gets larger and larger and larger because every year they have to pull out a larger portion of their IRA, so they're paying more and more taxes. Not a bad thing, that's just the way it works. When you look at this in terms of their assets, as they're withdrawing this money, their projected account values, they had almost all their money in IRAs. And so it was out here, and then they were going to have $662,000 left and out here at about age 93. They started with $1.1 million. Well, what if they did things a little differently? So, and here we see that $662,000. So let's suppose instead they delayed the start of their Social Security, and we converted some IRA assets to a Roth IRA. And now we see that there's yellow every year along the way. So they are paying some taxes right away. And we see a higher level of green, which is their Social Security. So again, I'm going to go back a few slides. Here we see they started Social Security early. This green piece was their Social Security. And fast forward, and we see there was no Social Security and then a smaller amount, and then all of a sudden a larger amount when they were both over 70. And so how does that impact how much money they have left? Well, in pictures, here is their asset path, and all of a sudden we see this orange color creep in, which is a Roth. And so as they're converting money to a Roth, they're not going to touch the Roth until later. And so it changes the path of their assets. Because of inflation, as they get older, they do still start to spend down. But now they have $920,000 at the end of their plan, versus the $662,000 later. If they didn't want to wait, just have more at the end, naturally, what that translates into is more spending along the way. So instead of just saying, great, you have more money to pass along to your heirs, that number can be translated into, you could spend about $3,000 or more from day one of retirement and still end up with your original $662,000 because of doing things in a more tax efficient way. So that's the difference that tax planning can bring to someone's financial situation. A couple other factors that fall into the withdrawing tax efficiently. One, Medicare Part B premiums. And so here's how the premiums work. When you turn 65, if you worked enough to be eligible for Social Security, you're also eligible for Medicare. And there's Medicare Part A, which is your basic hospital insurance. And then there's Part B, which you pay a premium for, and Part D, the drug plan, which you also pay a premium for. These are Part B premiums, and the base premium in 2019 is $135. But here you see these income brackets. So if your adjusted gross income is more than 85 for a single, more than 170 for a married, your premiums start to go up. And so there are several things that can happen. One, these premiums are determined by looking at your tax return 2 years prior. And sometimes people have a big event. They sell a piece of property or a business, or take a big chunk of money out of an IRA. They might do something not realizing that 2 years later, suddenly they get a notice that their Medicare premiums are going to go up substantially, and they, what happened? Now, there are 7 reasons you can ask for an exception. This Medicare premium means testing is called IRMA, the Income-Related Medicare Adjustment Amount. Yes, I got that right. And so one of the 7 reasons is retirement or working less hours. So let's say your income was much higher 2 years ago because you were working and now you're retired. You have to file for that exception, I believe, within 90 days of getting your first Medicare notice. And so it's important to look out for. But there's also sometimes, again, some planning that can be done to make sure that the way someone is withdrawing money, that it's not going to bump them up into this higher premium bracket. And then on withdrawing tax efficiently, there's also the healthcare tax credit. So if you're going to retire before age 65 and you do not have any healthcare available through your employer, then you're going to have to buy healthcare off the exchange. And believe it or not, there's this thing called a healthcare tax credit. And if your income is below 400% of the poverty level, you could qualify for this healthcare tax credit. For a single, that means if your modified adjusted gross income is less than basically 50,000, or married less than 67. Here's the amazing thing. I have a couple that was just in this week. They have a net worth of nearly 2 million. About 1.5 of that is in various financial accounts, and the rest is home equity. And they will have access to health care through an employer plan until they reach age 65. But if they didn't, they would qualify for this. We would be able to structure the way we take money out of their accounts so that they would get anywhere between $6,000 and $10,000 of credit that could be used to apply to their healthcare premium. We have another client that for, I think, at least 3 years, we were able to keep them qualified for the healthcare tax credit, and that resulted in somewhere between $20,000 and $30,000 a year of savings to them. It's remarkable. It doesn't have to do with how much assets you have. It has to do with what is actually reported on your tax return, and there are definitely ways to control that by the way the investments are structured. So those are all things that flow into the withdrawing tax efficiently piece. And to make it even more complicated, there are a lot of different things that depend on modified adjusted gross income, and there are different ways this is calculated. So modified adjusted gross income is used to determine if you're eligible for a Roth. But there they define it as your adjusted gross income, AGI, less traditional IRA contributions, but you get to add back any amounts you put into a Roth. So any amounts, I should say, you converted to a Roth. So converting to a Roth won't hinder your ability to contribute to a Roth. Then you have IRA deductibility. You have MAGI for the purpose of the healthcare tax credit. So for that calculation, you have to add back in any non-taxable Social Security that you're getting. And then you have MAGI for the purpose of determining if you're going to pay a higher Part B and D premium. And then you have to add back in any tax-exempt interest. And so in the models that we use, we have different rows that calculate MAGI differently for each one of these purposes, and a series of logic statements to help us determine which of these things apply. And because you're not going to remember. You're not going to usually remember on your own, so you kind of need software to help you out. So that brings us to number 6, which is applying all of this using an assumed tax rate. And so a lot of retirement plan calculators I see online do this. You just put in your tax rate, 15%, or I still see people using tax rates that are outdated. So currently it's 12, 22, 24. And so here you're seeing these are the ordinary income tax rates. Remember, different tax rates that apply to the capital gains and qualified dividends. This is ordinary income. And so what if we just pick? And a lot of people do for the projection of this, I think I'll be at 22%. Well, the challenge is that doesn't take into account any of those factors that we just looked at. It's kind of arbitrary. So if you just assume in retirement you're going to pay taxes at 22%, here's the tax hierarchy that's missed. So everything that's taxed as ordinary income, pension, IRA withdrawals, interest from government or corporate bonds, interest from CDs. But then you have the reduced rate and potentially 0% rate that applies to long-term gains and dividends. And then you have no taxes on Roth IRA withdrawals or municipal bonds or long-term capital gains if they're realized at 0, or qualified health savings account withdrawals. And then you have the interaction of the Social Security taxation formula and the potential eligibility for the healthcare tax credit and the benefit of Roth conversions that could reduce your tax rate later. And so those online calculators just don't capture the nuances of all of that. And using an assumed tax rate can often give you the wrong answer. You might think you're going to be in the 22% tax rate in retirement. Really, it's only going to be 12. Or I've had people that assumed their tax rate would be lower in retirement, only to find out that they had done such a great job of putting money in their 401k plan that their tax rate was actually going to be much higher in retirement. So be cautious about using an assumed tax rate. I think it makes sense to do a personalized projection. It's all customized to you, and that tax rate that you're using is then dependent on the types of accounts you actually have, how much money is in each one, and how much would be coming out of each one in any individual year. So as you start to put all of this together, this is the 2018 tax return, and it looks very different. So here we have items 1 through 7, and we start to look at, where does your retirement income fall? And so over here you have taxable interest, and you have your W-2 wages, you have your ordinary dividends, and I'm just going to get all my arrows in here. And so there's a few other things though, like let's just look at line 2. You're going to break it out into the tax exempt interest and the taxable interest. Qualified dividends, you're going to break it out into what was qualified and what was ordinary. IRAs, you're going to have the gross amount, but it's possible not all of it's taxable. How could that be? Well, let's say you put money into a non-deductible IRA along the way. Then every dollar that you take out, a portion of it's going to be return of basis from the non-deductible IRA, and a portion of it's going to be taxable. Then you have your Social Security benefits. And again, we just looked at, there's a portion that's going to be taxable or non-taxable. This is the gross amount, and then just the taxable amount goes here. Well, the first time I looked at this, I thought, well, wait, where's everything else? Where's the capital gains and losses? And what if you own a business? And so here you see this total income, and it comes through now from a different schedule. And we're going to look at that schedule in a second. This is Schedule 1, where that income comes in. So here we go to line 22. And what comes in here is your business income. This is where your capital gain or loss, if you had that $3,000 loss you were able to realize that flows through, this is where it would come. Rental real estate, partnerships, they're here on line 17. Unemployment compensation. If you became self-employed in retirement and suddenly you are filing just as a sole proprietor, that would show up here on line 12 in Schedule C. And so all of this gets added up and it flows through in here into this total other income line on the first page of your tax return. And then you also have, as part of Schedule 1, these other deductions. And so here is where you see your deduction for your contribution to a health savings account, your deduction for an IRA if you're eligible to have it be deducted. And again, all of these flow through, and the net result, if I go back 2 slides, a few slides, is down here on line 7 is what's called your adjusted gross income. So now as you're filing your tax return and you've looked at some of the different limits that we have in here and you're like, well, what is my baseline adjusted gross income? This is where you would look for it, as you would find it on line 7. So it looks a lot different, but the calculations that are happening are basically the same. So when we put all this together, this is a case study that I run through in the Control Your Retirement Destiny book, where I chart out a case for Wally and Sally. And I show 3 different options in how their financial assets look depending on how they withdraw, whether they withdraw tax efficiently and how they coordinate with Social Security. And this is what it looks like when you base decisions on your individual situation. And so here we were able to chart out, if they chose option C, which was delaying Social Security and using some Roth conversions, that was the result that actually maximized their wealth over time. Now, again, instead of maximizing their wealth, we could solve differently and said, well, what if you just spend more along the way? So you have the same amount of wealth, but you got to do some gifting or some more traveling or some additional things along the way. But the trade-off is, notice what it looks like in the early first, 8 to 10 years of retirement. It's not the option that maximized their wealth early on in retirement. As a matter of fact, they paid a little more taxes in their first 8 to 10 years of retirement. But it did provide more security for them when looked at over the whole 28-year time frame. If you want to learn more, you can find this case study in Control Your Retirement Destiny. And as Nancy mentioned, we have podcasted it also. So for those of you who prefer to listen instead of read, you will Google Control Your Retirement Destiny podcast. It's on iTunes. It's on Podbean. We are through chapter 10, I believe. The healthcare chapter was just released, and I have 2 more chapters to podcast. And then I think I will probably keep going with the podcast and start covering some other topics. But right now we just followed the book. Now, I mentioned that I would include some calculators. And so the calculators that I used here and how much of my Social Security will be taxed, it's a site called CalcXML. And it's literally, the calculator is called how much of my Social Security benefit may be taxed. There's also a 1040 tax calculator that I've used that's free. It's called Dinkytown. I don't know why it has such a strange name, but the calculator is great. Then there's software. So for consumers, the pricing ranges about $100 to $300 a year. Larry Kutlikoff has one called ES Planner that calculates things in terms of consumption smoothing. So what I was talking about, if this strategy can result in more spending from day 1 of retirement, that's how his software works. It will calculate out and translate everything into higher consumption. And then there's one called Wealth Trace, which I haven't had a chance to use, but I'm very intrigued by because it looks like it actually does the taxes correctly. And that's the challenge we have, is in finding consumer options out there that are actually doing the taxes correctly. For advisors, what are some of the tools we use? BNA Tax Planner, same tool used by a lot of CPAs, and Finance Logics is a package that we subscribe to, and they run about $1,000 a year. And why the price difference between consumers and advisors? Just different features that are available, different customer service lines, and of course we have to be able to save multiple client cases versus if you're a consumer, you only need the ability to save your own. And so that works a little bit differently. For those of you who are interested in working with an advisor, all our services start with a complimentary conversation, and we ask that everyone first fill out a secure online questionnaire. It doesn't ask for any personal confidential information, just general questions, and you can find that on our website, or you can email us the subject line PMQ to info@sensiblemoney, and we'll email you back and have a link to it. And in terms of hiring an advisor, I want to talk through something really briefly, and then we'll open it up to questions. So a conversation has come up recently with a group of my friends around who needs an advisor? And I am a big fan of all different kinds of service models. So some people are very comfortable reading a lot of finance books and magazines and going out and doing it themselves. And so they may open accounts at Schwab or Vanguard, or in that case, I sent my younger brother to Wealthfront, which is a robo-advisor. And that sounds kind of like an odd term, but they're fantastic. They do all the investing, they automate everything, they do the tax loss harvesting for you. And for the pricing, you don't get a full service financial planner with that. So there are certain services, I call it call center pricing. You call and you press 1 for this and press 2 for that. And so you might get a different person each time you call. And so the services are priced, they can't deliver full service for not full service pricing. And so then there's financial planners that charge on an hourly rate, and you have to go out and implement what they do. And I think those are great options, again, for people who want to do their own paperwork, do their own legwork. If the hourly planner decides to go into a different career, you have to find someone new. But you're not going to pay a lot for that service, and you get to choose when and how and what type of advice you want. And then there's full service pricing, which is our type of firm. We work with clients who want to delegate. We become 100% responsible for delivering the retirement paycheck in their plan, and people expect that we're going to respond promptly and quickly, and they have a dedicated team that knows their situation inside and out. It's not, somebody with an accent they can't understand. And we've structured the firm so that if underlying planners change careers, we all do things the same way. So our goal is really to make a lifelong commitment to our clients. And it's very different than a solo planner who, it isn't trying to build something that for the long term. And so there's no right or wrong. They're all different service models. People are looking for different things, but I like to kind of put it in perspective. I see so much in the media out there bashing certain types of models, and I'm like, why? There's room for all of these models. We are all different, and have the ability to pick and choose how we want to consume our financial services, how we want to acquire that. So with that, I am going to open it up to questions. Nancy, I don't know if you have seen any come in.
There are a few questions, Dana. So you did address the questions about the wash rule earlier. There was one about when you're talking about the tax returns. It starts with 5852 is part of the total dividends. And then, or stated a different way, qualified dividends are included in the adjusted gross income. Is that correct?
Yes. So qualified dividends are included in adjusted gross income, but there's a different tax rate that applies to them. Same with capital gains. So they are part of your adjusted gross income, but there is a different tax rate that is applied to them.
Okay. There's a question about whether there was a spousal Roth IRA, and I think you addressed that. The answer
there is, yes. But I'll answer it again because I think it's great and people miss it. So let's say you have earned income and your spouse doesn't. You are able, again, you have to fall under the income limitations, but you can make a contribution on behalf of a spouse. It's called a spousal IRA. They don't have to have any earned income. So we have, many couples where we get them to fully fund IRAs or Roths each year because one just makes a spousal contribution.
Okay. There's a question here. Before I give you the question, I'm just going to say there's a term that I haven't heard in a while. It's called dividend aristocrats. And I actually had to look it up because it's been a while. Dividend aristocrats are S&P 500 index constituents that have increased their dividend payouts for 25 consecutive years or more. And so this question is, in planning for distribution, if I'm planning to retire within 5 years or sooner, is it better to stop contributing to a 401k and use that normal annual contribution to buy discounted company stock option? My company is a dividend aristocrat, so that I can accumulate dividends at 0% tax instead of continuing to contribute to the 401k and locking myself into having to withdraw and pay income tax later as well as RMDs.
That is a fantastic question. I can't answer that specifically for you. You know, it's some of these questions. I'll tell you, my gut sense is that is definitely an idea worth looking into. You know, like a doctor, it'd be kind of like telling someone your symptoms and then saying, prescribe me medication. So, you know, without doing a full financial plan, we can't know the answer because we don't know all of the components that will impact your tax rate now and later. But in general, that sounds like something definitely worth looking into.
Yeah, yep. Another question, I have some company stock in a 401k that has a low cost basis. Compared to what the stock costs today, and was planning to use the NUA to move the stock to a personal account, and was wondering if I should wait to take Social Security until I complete the NUA movement for tax reasons.
So NUA, for those of you listening, is called net unrealized appreciation, and there's a certain tax rule that applies to company stock and 401k plans. And so again, like the former answer, I don't know for sure, but it definitely sounds like a strategy worth looking into. So we've definitely had cases where, you know, we looked at distributing the client's stock in kind. How NUA works is you can distribute the stock from the plan in kind. You only pay tax on the basis. So let's say, you know, the stock was worth, I'm going to use an exaggerated example, but let's say it was worth 100,000 and your basis was only 50. When you distribute it, you only pay taxes on the 50, and now the difference will get long-term capital gain treatment, assuming you hold it long enough. And so there's all kinds of factors that go into that. How much of your wealth is in that stock? And so from a risk standpoint, you know, what if the stock were to drop 20 or 30%? That becomes a factor. What proportion of your overall worth is it? But from a tax standpoint, it could definitely be a strategy worth looking into.
Absolutely, yeah, absolutely. Another question here. So if the older spouse starts Social Security at age 70 and the younger spouse by 4 years starts at 66, you may be better off because of lower taxes instead of both waiting until 70 years old? And that's got a question mark.
Don't know. It all depends on everything else, you know, happening in your tax return. You know, a common strategy for maximizing Social Security benefits themselves is to have the highest earner delay, because that maximizes the survivor benefit, and to have, you know, the lower earner claim earlier. So what you described is a very common strategy. I don't know necessarily that it would have tax benefits. You know, it's impossible to say.
Yeah, yeah. We've got a few thank yous thank you so much for offering the webinar. They enjoyed it. Get to a question. Can a working spouse and a non-working spouse, high income, still make a non-deductible IRA contribution for 2018?
Anyone can make a non-deductible IRA contribution as long as you have earned income, I should say. So yes. You know, non-deductible contributions are, you can still do that. You have until April 15th, your tax filing deadline. Now, there is a tax form. I think it's Form 8606. So if you make non-deductible IRA contributions, you want to track that. You want to have your accountant track that on a form so that you know what your basis is. So I have had people that, one actually an accountant who is my client, and made non-deductible contributions long before he ever hired me, but then just went to take withdrawals and had no record of his basis. So he had to go back and track it all down. But you want to keep a record of it because otherwise you'll be double taxed on it. So you have to track the basis portion in that.
Another question, does your firm only do tax advising for those who already have a financial investment advisor?
So we only do tax advising for our clients, so I'm not quite sure how to answer that. You know, generally, if somebody was our client, what we call our full service client, then every year we're running a tax projection for them and giving that kind of tax advice, but we don't do it on a kind of standalone basis.
I'm wondering if the question has to do with just that. Do you only do tax advising for your own clients? And I think the answer, of course, is yes.
Okay. Yeah.
Okay. So in your strategy planning, would you consider in your in your strategy planning, would you consider strategies like Pay Zero Tax by David McKnight and The Value of Debt in Retirement by Tom Anderson? Please explain.
So I know The Value of Debt by Tom Anderson. I like that book. Yes, we do consider that. I'm not familiar with David Knight's, but my guess is it's very similar to something called The Roth Revolution by James Lang. I don't know, though. So I'd have to know more about that. You know, if it has to do with converting everything to Roth IRAs and then paying zero tax later, I've seen that strategy. It can work. It all depends on the situation. And I have also seen ones that, you know, zero tax ones that promote putting everything into whole life insurance policies. I'm not as big of a fan of that. I have seen one case, but that's only one case in my career. I've been doing this since 1995. One case where that worked out well. Now, in that case, it worked out really well. So I've seen a lot of things on paper where it's supposed to work out, but in real life, it's, you know, some of those strategies don't work out as well in real life as we would like them to.
Yeah. Okay, more. Thank you. This is great. Thank you. This is great. And let me get to find a question. Okay, so here's my TurboTax software allowed me to make full, I think it's Roth contribution, yet our line 7 AGI is 340,000. But 350,000 of that was from an IRA to a Roth. Was the Roth legal?
Yes, so that's back to that slide we looked at that had the 4 different types of modified adjusted gross income. And for the purpose of contributing to a Roth, it was your adjusted gross income less any amounts converted to a Roth. So if it sounds like in your situation, you know, most of your income was from converting an IRA to a Roth. So it sounds like it was perfectly legal. And I also see you have a second question, can RMDs be put into a Roth account? So not technically. When you take a required minimum distribution, you have to take it out of the IRA. If you're still working and have earned income, you can make a Roth IRA contribution. You can also convert a portion of your IRA to a Roth, but they're all separate tax rules. One thing you can do with your RMDs that I meant to touch on, but I forgot, was a qualified charitable distribution. So if you are over 70 and a half and you don't need your IRA money for consumption and you tend to give to charity every year anyway, if you give it directly from your IRA, it has to be your RMD, meaning you can't take your RMD and then gift an additional amount to charity. The gifting to the charity has to be the first part that comes out of the IRA. Then you actually get to reduce your adjusted gross income by the amount that went directly to a charity. So it's called a QCD, or a qualified charitable distribution. And so that's really the only option you have for your RMDs to kind of help with any kind of tax efficiency.
Okay, and the follow-up to your explanation was, thank you very much, now I can sleep.
Great.
So will you be providing a copy of the seminar to us via email link in a few weeks, as you have for past seminars? The answer, absolutely. Yep. Do you do tax projections as part of your plan, or only for assets under management clients?
Only for assets under management clients. So we do, well, let me qualify. When we go through all of our clients start with a planning process, and that plan can be a standalone service. About 75% of people that go through that planning process do hire us for then what's called our full service, where we manage the investments and update the plan each and every year. When we go through the plan, we do a tax projection, but it's a long-range tax projection, but it's actually a software we use that does a tax return every year, so we can identify those different withdrawal strategies and what might work and what your tax rate might look like. It's not as exact as a tax projection because we have this general projection, but then every year things change. Mutual funds distribute a different amount of capital gains, or you have to sell to rebalance, or your job changes. And so for clients that go through our planning process and then hire us on the full service, then in addition to the long range tax planning every year, we also do a tax projection in the fall. So we're gathering all of the information that we think will actually be on your tax return, and we're trying to pinpoint, last year we thought you might be able to do this, this, and this, but what does it actually look like this year now based on these tax rates and what's changed? And so that individual customized tax projection we only do for our full service clients, and we're super busy at that time of year. We just wouldn't even have the capacity to do it for as a standalone service.
I am considering starting partial IRA conversions up to the point of the top of my current tax bracket year after year. Does that make sense?
Okay, read that for me one more time, Nancy.
Sure. I'm considering starting partial IRA conversions, Roth, I imagine Roth conversions.
Yeah.
Up to the point of the top of my current tax bracket year after year. Does that make sense?
So it probably makes sense, but again, I don't know what the top of your current tax bracket is relative to what your tax bracket might be later. But you're probably, by the nature of asking that question, pretty smart, and you probably know the answer to that. And so my gut sense is probably that makes sense. So a lot of times we will develop strategies where we are filling up to the top of the 12 or 22% tax rate, sometimes to 24. Rarely do we convert beyond the 24% tax rate. But again, every time I say that, I don't like to say all or never, because there's always cases where you'll find something where it actually does make sense.
Is it better to wait until we retire to convert traditional IRA to Roth after retirement, so that we would likely be in a lower tax bracket at the time of conversion?
So, again, this is one of those, without knowing your situation, I don't know, but probably. So there's many cases where, if you and your spouse are both working right now, we look at that, and then we look at what your tax rate would be perhaps, in the first 5 to 10 years of retirement. And those often become these opportune years to do Roth conversion. So don't know your situation, but in general, that strategy often makes sense.
And this, I was going to say this is the last question, but one just popped up. So I believe that your company only handles customers with $1 million portfolios. Is this correct? Do you have any recommendations for those of us who are just getting started and have a much smaller portfolio? I absolutely love everything I have seen and read.
Thank you. So no, we don't have an actual hard $1 million minimum. What we do is we do a plan, and our pricing on our plan generally runs about $6,900. In very simple situations, we will discount that price. I don't even know if discount's the right word, but we do change the price. If it's, for example, a single person that has one 401k and a house, that's very different than a lot of our clients that are married and have rental properties and have, all different kinds of company benefit plans. So if it's a very simple situation, then we lower the pricing on our plans. And so oftentimes we've had people come through that have assets in the, $500,000 to $1 million range, go through the planning process and get a tremendous amount of value out of it. And, I don't know without doing an introductory meeting with you, we do try to be very fair and straightforward. There's no cost or obligation to an introductory meeting, and then try to give you some options from there. But sometimes we do refer to other planners. And so I was going to say, if you're comfortable working with someone remotely, one of the firms that I refer to is called Branning Wealth Management. They're out of Louisiana. So Jason Branning, the founder, we have a very similar philosophy, and a great person. So we'll exchange referrals back and forth too. So that could be an option for you.
Here's a question statement. I missed the healthcare part relative to Medicare Part B costs. We are the couple with the AGI on line 7 of $340,000 for 2018. We turned 65 in May of 2020. Will we get hit with the IRMA penalty since it is 2 years in arrears? Can we appeal this if we are penalized? Can we ask Social Security?
I know what you're asking.
Yeah.
So your adjusted gross income, that's going to be around $340,000, $350,000 on 2018 tax return. It will show up in your 2020 Medicare premiums. Most likely, you absolutely will get a notice saying that you are subject to the higher premiums. And so it doesn't take effect immediately. It'll take 2 years for that tax return to flow into their system. I don't know if that's a legitimate reason to appeal, but I'd sure try if I were you. So I would, file the forms. It'd be hard. Like, if you could also say that around that time you retired. Yeah, I'd have to pull up the form. You can Google the form, IRMA, exceptions to IRMA. There's actually a form you can go and read, all of the reasons that you can qualify. But my opinion is it sure wouldn't hurt to try, but you're not gonna even see it till 2020.
Yep. Damon, that looks like the last of the questions. And so is there anything else that you wanted to?
No, there was a few. There was one other question I thought I saw in there. I saw someone say, that did you say you can do an exchange in the same fund family? Yeah. And it can still trigger a taxable event. I don't know if I answered that, but the answer is yes. So even if let's say all your money is in Vanguard funds and you move from one Vanguard fund to another Vanguard fund, that is a taxable event. If it's all in your 401k and you move from one fund to the other, that is not a taxable event. So that question, and then I thought there might have been one other one.
About the wash rule that you covered. Yeah, I don't think so.
Let me just glance through. No, I think we got them all. Hopefully we got them all. And so thank you, everybody.
One more.
All right.
So what is your opinion regarding employee stock options? Do you recommend exercising outright or actually buy and hold?
So I have recommended both, depending on the situation. It's our famous answer. Don't you hate that? It depends. But again, it does depend, because in some cases, someone has so much exposure to a single stock that we're like, that's too much risk. You need to get out of it. And in other cases, the exposure isn't so great. They have a lot of other diversified assets. And so we look at the potential tax benefit for, exercising and holding. It depends on the type of stock option too. There's incentive stock options, and then there's non-qualified stock options. So there's really not a whole lot of tax benefit for holding the non-qualifieds, but for the incentive stock options, there can be a tax benefit for exercising and holding. So sorry, I can't give you a crisp, clean answer, but the answer is I have recommended both in the past.
Okay. All right. I think that that concludes the questions.
Great. Well, give us
one more. If this maybe the last one. So if you can afford it, this is a follow-up. Is it better to own dividend stocks versus spend down?
So here's the challenge. There's all kinds of investment strategies that work. I have definitely seen people accumulate a lot of dividend paying stocks and just live off the dividends. And I think that strategy can and does work over time. And if anyone knew exactly what the best strategy would be over the next 10 or 20 years, of course, that'd be magic. That's what we'd recommend. We don't use that strategy if we're responsible, and there's a particular reason we don't. In 2008, 2009, a lot of companies cut their dividends. Some of them eliminated their dividends. And so if someone was relying on those dividends for their retirement income, suddenly their income got cut in half. And at the same time, the stock price dropped. So if they actually had to have cash and had to sell stock, they were having to sell it at a discounted price. And so for that particular reason, when we're solving for someone's retirement cash flow, we need it to be stable. We assume someone wants a very stable standard of living and that they don't want to suddenly have to make a significant amount of adjustments one year. So we won't use that approach, but I've definitely seen it be effective. And I know some people, it's the only thing they're comfortable with is owning things and just living off the dividends and the interest.
Okay. Question on an HSA. Can you only add to an HSA up to age 65?
Correct. So you can fund HSA accounts up to age 65. Once you're 65, you cannot fund them anymore.
Okay. Can you add to it in your 65th year or not, since Medicare kicks in?
You can actually add a prorated contribution depending on how many months of the year. Isn't that crazy? Why do they make it so complicated? But yes, so, if you were 65, halfway through the year, you could make half a year's contribution to your HSA for the first half of the year that you weren't 65. And another funny rule, HSAs, your catch-up contribution, you can put an extra $1,000 in once you're 55 and older, but for your regular IRAs, your catch-up contribution starts at age 50. Now, why couldn't they make that the same? I don't, why do they make it so difficult on us?
Here's a follow-up. Crazy. Somebody agrees with you. Great. So
Thank you for agreeing. It is very, very bizarre out there. I don't know why they do this to us, but I suppose it's job security. It's the way to look at it.
Okay. So I don't think that there are any more questions. That was the last. What is your opinion on long-term care, on the role of long-term care in retirement? Is it better to have one that pays you more upfront or unlimited later, but you are responsible to supplement early on?
So I'm not actually aware of many policies anymore that will pay unlimited. So I'm not quite sure how to answer that. I mean, most of the policies I see are kind of, pay as you go. So if you need the care, you're reimbursed, and they will either reimburse you on a cash basis, like a certain amount per day, and some require you to have receipts and some don't. So there's some different nuances there, but I'm not really, unless you're referring to like a waiting period, you could have a 90-day waiting period or a 180-day waiting period. Normally policies are structured where, might do 90 days because typically, for example, if your long-term care comes immediately after a hospital stay, then Medicare will cover some of that. But if your long-term care didn't come after a hospital stay, it was more deteriorating, then Medicare doesn't cover it. So there's all kinds of nuances there. So I don't know. I don't know enough about the types of policies you're asking about.
Yeah, and there are so many different ways to structure them. So should long-term care be part of retirement planning is the follow-up question.
I think absolutely. We use a projection that looks at the median cost of, the median for the U.S. nation is 5 years of care. So we look at the median and how your plan would work if you experienced, that event, you needed a 5-year stay. And so that kind of helps us see if you would need additional insurance or not. The other factor is whether you have home equity or not. And so for clients that don't have long-term care, we like that home to be a reserve asset that could potentially be used for long-term care. For those that do have long-term care, then, preserving that home equity is not as critical. So there's some different planning tools around that.
Mm-hmm. Can you contribute to an HSA while unemployed?
Believe it or not, yes. And so with almost any type of normal retirement plan, you have to have earned income, or if you have enough earned income, you can contribute on behalf of a spouse who doesn't. But with a health savings account, you don't have to have earned income to make a contribution. But you do have to have a high deductible plan that is eligible to be paired with an HSA, and your insurance provider can tell you whether it's eligible or not.
Okay, and if I retire before 65, can my spouse qualify for the extended 36 months of COBRA health insurance if I turn 65 before the first 18 months of COBRA ends?
I don't know. That's a great question. You would have to ask, so I'm trying to think so I just had a case, for example, but this client works for the state, and she is turning 65, but her spouse is not. But she's able to keep them both on the state plan until he reaches 65. So, but it's one of those things where you have to call your benefits administrator, assuming you work for a large company that's got 20 or more employees. Generally, you're going to have to ask them how that works. How does their plan coordinate with all of that?
Yeah. Another HSA question: can't you contribute to HSA after 65? If you are not on Medicare and don't plan on being on Medicare within the next 6 months, Medicare A going back 6 months?
That's one of those things where that sounds familiar. It's one of those areas where I said we don't remember all the rules, but we should know enough to know, I think maybe that might be true. I don't know for sure. I don't know that one off the top of my head, but that does sound familiar. So now you've got me intrigued, and I'm going to have to look it up.
Okay. All right. And at the moment, that was the last question, but.
Great. Well, we'll go ahead and wrap up, and
Okay.
I'll hopefully get better and get my voice back,
Yeah.
So thank you, everybody, and Nancy. Thank you for joining us. And this is recorded, so we'll send a recording out and we'll send a copy of the slides. And we really appreciate you taking the time to join us tonight.
Thanks, Dana. Have a good night.
All right. Bye, everybody.